Hello and welcome to the Harwood Report for December 11th, 2017. I am Keith Harwood. The Harwood Report is presented by Trade Academy. I am the founder of Trade Academy. Let's get right into it. Normal disclosures, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. None of this should be considered a trade recommendation. Do your own due diligence before entering into any trade. This is basically just telling you this is how I'm looking at the markets this week. None of this is a trade recommendation for you. This week's highlights, as I've been doing for the last few weeks, we're going to stick with looking at the macro indices. They're getting to an interesting inflection point here, particularly SPY. Bonds and gold should be very interesting this week with the Fed meetings. We've got the United States Federal Fed, we've got Bank of England, we've got the ECB, so that could have some real impact on yields, currencies, and thus the precious metals as well. Oil, it's been pretty choppy, but I think that there's some good trades there in XLE, OIH, etc. So we'll get right into it given all of this. The first thing I want to do is start at fear and greed. 60. So we had that pullback and then the bounce back. There's nothing overly frothy about this market on the whole. So when I look at the whole market, there is money flow potential into the market. It's not necessarily that it has to happen, but there is room for more greed. And room for more greed means I don't have to sit there and say that there's no way the market goes up. Good example of that is SPY. So we had a couple day pull down here. Obviously, we had the big drop and then recovery, breakout, fall back to the 10-day moving average, bounced off the 10-day moving average. We're creating a nice little wedge here, actually, where one of two things is going to have to happen pretty soon. We're either going to make a new all-time high above 266.80, or the 10-day moving average isn't going to hold. That's a really good trading opportunity for me because it creates inflection points. We're not at either of them quite yet, but that's how I'm going to want to look at how this is going to trade. Either basically trade the breakout above 266.80, or trade on the fade below. If it was today, it would be 264.08. So I don't think we're going to get to either of those today. We're making higher highs and higher lows, so the most likely next dollar is probably to the upside, and then that's either going to be a double top that fades back to the 10-day moving average and maybe below down to the 20, or it's the breakthrough and we push towards 270. Once we get up towards those highs, that's when I'll be looking to make a trade, because if we push towards 266.80, I expect to see volatility lower. That allows for really good option leverage for me, whether I want to play for the breakout or the fade, or something that plays for one of those two happening as opposed to consolidation. So that's what I'll be looking at later this week, and likely I think that the Fed meeting may be sort of a trigger as a catalyst. It doesn't necessarily have to be bullish for the market, but it may be the catalyst that gets some money flow into the market or money flow out of the market. Qs, we know that this had a little bit of a harder time last week. It faded below the 10 and 20-day moving average. This could be a good candidate for some sector rotation. I know that the Qs have been hit hard by semiconductor underperformance, people making money there. Rumor was that there was a big fund that had to unwind a position long a lot of tech, likely a lot of semiconductor names, and short some retail names, and short some, telecom names, like the Verizons of the world. You can see that Verizon had a very big rally here while the rest of the market was fading. Disney, media companies really had those big spikes higher when the market was having its fade, and then SMH, as I said, that was getting hit during that time. So that kind of makes sense that there was somebody that just had a big position that was getting hit on two ends and had to unwind, and that helped push the market a little bit out of whack. So I like the Qs to potentially be a little bit more likely to be firm here, just as the money rotation corrects itself. This 3-4 day period already saw some money flow in there, a little bit at the expense of IWM. We see that the spread is around $4 now. IWM was trading above the Qs by that point. Now we've got about a $3.5, $4 spread. It had been trading as high as about $8 earlier this year. I wouldn't be surprised to see the Qs go back to $8 above IWM, unless something drastic happens with tax reform or the US dollar. Again, I think that the Fed meeting on Wednesday is going to be a really big one, because it's Yellen's last one. And she's going to have her final press conference. She's going to want to leave, her final remarks out there for how she thinks the Fed should be guided forward. She also might just say, never mind, I'm not going to say anything. But a lot of times people talk about Powell being a little bit like a Yellen clone. So whatever she says, I expect to be setting the stage for what Powell might want to do, actually. So given that, I think we have to be a little bit cautious this week in getting overly aggressive on anything until after the conference on Wednesday and the market gets a chance to react to the Fed. I don't have an edge on what Janet's going to say, which means I can't really get overexcited about positioning ahead of it. Where I can position is when the technicals are lining up and we get to an inflection point. Like if we get to that SPY high before the Fed meeting, that's great. Maybe I can buy a straddle to trade for just movement on the Fed. But without that, right now, I'm going to be very nimble and wait for my spot here. And right now, I'm not at my spot in a lot of this stuff. Dow Jones Industrial Average, it's the mini, it's the S&P again. So I've been talking about that for a couple weeks now. The Dow Jones basically just looks like the S&P. We had a little bit of a divergence around here, and then as soon as the Dow Jones got that catch up, now it just looks like the S&P again on the recent term. We're looking at buying on a breakout above the 200 of the all-time high, or selling on a break below the 10-day moving average, knowing that that should then target the 20 and maybe even below, since the 20-day moving average didn't hold last time. So that's got some good leverage to the downside or to the upside when we get to the inflection point. And again, I think that first inflection point, it's more likely to press against the high versus the low. But I'm going to kind of be in wait and see mode. I don't want to be aggressive until something changes that gives me an edge. Where I do actually think I might have an edge here is TLT. So we've had some big ranges. And while we've had these big ranges, TLT, in my opinion, should be trading lower. I think what's holding it up a little bit is some of the risk parity stuff. There was, with the unwind of the equity markets, there was some buying of bonds. So positioning-wise, it seems like the long is starting to get off sides in bonds. We've got the Fed this week. We can get some leverage this week. So I can go right here to TLT. Now look at the implied volatility. And obviously it's a little bit firm today, but over the last 6 months, there's your price chart. Here's my vol chart. Yeah, there we go. So it's kind of middle to low end of the range, 9.6%, but realized vol has been over 11%. That's what gives me my edge. Gamma is underpriced, especially with an event this week. Yes, the December option is pricing it in. It's over 12%. But if I go down here, clear the vol and set it to the market implieds, and go to next week, and I'm looking at 10%, or the following week, and this gets into end of year stuff, so there may be some weird pricing. That's about 10%. Or I can go all the way out to January and get a little bit of the new year allocations as well for under 10%, 9.7%. That's near the lows of where TLT volatility goes. It's got some gamma, it's got some leverage, it's got some edge. I do think that this is a spot where there's some potential for money to be made. A little dividend coming out at the beginning of the year. Honestly, the way I'm looking to play this is going to be via straddle. So I can see the Jan 127 straddle right now is 330. That gives me my leverage. So I'm saying that this movement's going to be more than the 9.9% implied there by the straddle. So I'll be looking at something here, long a straddle, maybe long a strangle, but for now I'm looking at the Jan 127 straddle at 330. It's actually a little less than that right now. You can see, where's my complex window here? There you go. So right now it's a little under 330, 328, we'll call it, for mid-market. So that'll be my first trade I'm looking at here is the TLT straddle for 328. That will also help set the tone for some of the precious metals and everything else. So yeah, that I think is just too cheap at that level. Okay. Next up, so off of that, if TLT is weak, which is what I would lean towards, I expect the weakness to happen. But if it breaks out, that's going to obviously have an impact on dollar yen, risk on, risk off type behaviors. Dollar yen's been firm. It's still above all key moving averages, but it's not quite to that key inflection point, which is 114 and change. 114 has basically been the zone where dollar yen gets hit. Cannot seem to break through that level. Maybe this time it will. This is a lot like my strategy going forward in the S&Ps. I want to see the move to 114, where I can then start to position in options in gold and silver for the breakout, which like 119, or the fade back to say one of the key moving averages here around 112. The real leverage mode is when when dollar yen crosses the 10-day moving average. Until dollar yen crosses it to the downside, I'm a little lean here. So again, when I get to 114, I'll actually probably look for a a complex structure, and I'll outline it in the premium thing. It's too complex to talk through here, but I'm looking for something where gold gets either very bearish or a bounce back and a little bullish. So we look at the GLD chart. It's had a big. I don't want to be aggressive selling down here without something changing in dollar yen. So when dollar yen gets firmer, that would push gold down to 114 or maybe lower. If dollar yen recovers, we're looking at a move back to 122. That's a large range, and I can easily play this in the options. Because if I look at GLD now, a January straddle is a good example here again. So I'm looking at straddles a lot this week. You'll note the January at the money straddle is 305. If I use the 119 line, 307 on the 118 line. Use the 19 line because that's got a little bit more leverage, just at a little bit cheaper price, and it's further in the money. So I like that idea, actually, of the Jan 119 straddle for 304. I don't mind buying that now. Part of what's discounting some of these January options is the fact that we're going into the holiday season and people are a little bit nervous. But when I've got a big event this week, if that triggers big movement, who cares about the holiday coming in? I'll have an opportunity to P&L my trade. So right now, I'm looking at these straddles as ways to have some leverage for this week's events and know that sometimes in holidays, you lose liquidity and so you get even bigger moves. But on a move to 114, 113, I get really well paid and sell out the 119 puts and then, leave the 119 calls on for free. And if we move back to 122, again, that's the straddle value. So there's no real huge pain for me as long as we continue to get movement. If we stop getting movement, that's what hurts. So once I'm in a straddle, I have to just manage my daily expectation on the movement and make sure that I'm trading around it. But with an event on Wednesday, that can create a big one directional move, and then I can decide what to do after that. All right, so that's GLD. Next up, we'll look at the miners. Miners are basically oftentimes a leveraged version of GLD. This time, if the miners can't hold here, that's going to happen if GLD can't hold where it is, and that puts GDX down to 18.5, 19 potentially. GDXJ, same idea, could go down to 27. The interesting play here for me is after my gold play. So after gold moves, then I'll go to the miners. Because the miners have a leverage. The miners also often are a little delayed on the flip of the trend. Right now, junior gold miners are actually leading. You see that they've been up 2 days in a row. GDX has been basically flat here, and GLD has been basically flat. So what that's telling you is that maybe the positioning on the short side of GDXJ is a little bit stretched, and we need to get a bigger break in GLD before the next leg lower happens in GDXJ. One way to play this little bit of divergence here for me might be just a pairs trade, buying some GDXJ puts and buying some GDX calls because of the level of vol. Again, vol's come up a little bit, but it's still relatively cheap. GDX, same sort of thing. On GDXJ, though, what I'll look at this week to start is, I'll be looking into probably the end of year stuff and know that if volatility gets hit post-Fed, and GDXJ hasn't moved enough yet, then I can look at either some puts or calls here, but I don't know which one it's going to be yet, so I'm not going to get too aggressive with this. Okay. So that's it for the metals. Oil-wise, it's pretty simple right now. We just look at USO. It had a pullback, couldn't really break up below here, but got below the 10 and 20-day moving average. That's not particularly strong. I like this a lot like I would like the S&Ps. It's kind of sideways. A move on USO above 1175 gets me that much more bullish. Sorry, 1170, what is it, 1179 officially. So, pushing towards 12 gets me really bullish in XLE and OH. And a move below this low of 1118, I have to now start worrying about the downside. XLE had lagged the move up in general, and we can see right now that it's retesting the previous high that it's made twice. This is a potential for triple top, but triple tops often don't hold. So I've got a little bit more bearish bias on the whole here, but nothing too aggressive until USO clarifies if it can get the next move up. If I want more leverage, it's OIH. So OIH is not back to 26 yet, and a move above 26 here opens up this upside for a lot of potential 30 plus. You know, you can just see how big how much this is underperformed. Where XLE is pretty much in line with where it was in April. OIH is still down 15% from that level. So that's got a lot more leverage to the upside. Obviously, the profits have already been, you know, there have already been some losses there in the oil explorers while oil was staying low. But as oil comes back, these are the companies that have a lot of leverage to the upside. This is the same idea as when I was talking about like the junior gold miners. They're the worst performers when oil is weak, but they have that much more leverage to the price of oil when it starts to recover. So that'll be my final trade I'm looking at here, and that'll be an OIH. See, vol's already actually picking up a little bit today, up 1.5% on the day. Chart-wise, 26 is not cheap, but it's certainly not expensive. We've been over 30%. Realized vol is 26, 27%. So this is priced pretty well for me. We're getting the movement. I think there's a potential for even more, and I still really like this Jan stuff. Even out to April is not bad, but I'll focus on Jan here. And I'm going to look at these Jan 27 calls for 14 cents. We do have a 50-cent dividend. That puts us basically at 24.70 once the dividend goes next week. So that'll put the price just below 25. 27 calls or the 26 calls. I'm going to focus on the 27s because of that big leverage. I'll move to 26 and I will have to potentially consider a hedge. But above 26, this gets explosive. So those 27s for 14 give me a lot of room. So that's what I'm looking at in OIH. All right, folks, that's it for this week's free report. I'll have the premium report out, the Harwood Report, the paid version, in a couple of hours. Reminder, you get a free trial on that. If you're interested, you get 30 days, so you can see what more I'm going to be talking about. I'll talk more about my GLD strategy going into the next week as prices in dollar yen start to adjust. I'll talk more about how I can trade those S&P, Qs, IWM ideas I was talking about, because a lot of this is about trade construction and how to put together a good trade in using options. Again, it's a month for free, and then after that, it's only $49 a month, so it's actually really cheap relative to the other stuff out there. But you know, we're giving it away at a nice discount here into the end of the year. So hope everybody enjoyed the video, and look forward to seeing you guys next week. And those of you that sign up, we've got that report, and then the midweek update this week where, for example, last week I talked about why I was getting more bullish in the market, and obviously that's working fairly well here today. So we'll talk on Wednesday. Thanks all. You can always contact me. There's my website. Email is keith@tradeacademy.co, no M. You can call me 312-600-8004 with questions or comments, and follow me on Twitter @TradeAcademyCo. Have a great afternoon all.